what I'm trying to do on this show is look at companies that I think are interesting for us to dissect. These can be good companies that I think are going to be fantastic long-term investments, but also I think it's important to look at the bad companies. I know it's not quite so entertaining, quite so exciting when we look at a company and they get nowhere near the grade, but I think it's important to have that perspective on these companies, because if you're just looking at the best, it's difficult to then really understand just how good they are. When you're just looking at great companies, it's difficult to really rank them. When you look at those companies in comparison and in relation to some of the poor companies we've been looking at, nearly swore then, some of the really poor companies we've looked at, it really gives you some perspective on just how much better some of these companies are. And so I'm trying to put a proper mix together. And that's a mix of companies that I'm putting forward that I want to share with you guys, but also requests that other people have asked for. Today we're going to look at another request. Today we're going to look at a company called JD Weatherspoon. Most people have heard of this company. Let's get started. Hey there guys, welcome to the FTSE Show. My name is Chris Chillingworth. So listen, we have been doing this show now since January. The show is growing. Thank you so much for your likes and subscribes. And I showed that chart last week, showing the subscribers rising and everything. It was fantastic, and the views going up, and the channel is booming, and it's really exciting for me, and I really appreciate it. Sometimes I get some crazy emails from people, and I guess that's a sign that the show is doing better than before. Someone once said to me, if you don't get hate mail, you're not doing a good enough job. And I kind of start to see what they mean by that now, because I'm not quite getting hate mail as such, but I am getting some crazy emails, and so from some people who are very passionate about the stocks they're invested in, which is fair enough, but it's hugely emotional investors out there. A lot of people are misunderstanding the point of what we're doing here, and I wanted to use this episode today just to reinforce what we're actually doing. Because just because a company scores under 70, 60 on this chart, it doesn't make them a bad company. The scoring system here is simply my interpretation, is to give me a visual on companies that have hit all of my indicators, all of the things I want to see in a company. Now that might be different from investor B, C, D, E or F out there who have a different strategy, that are looking for different certain metrics in a company, that are looking at different time frames. They might be looking to get in and out in the next year or so. I'm a long-term investor, so I'm looking for companies I can buy and hold for 10, 15, 20 years. I'm looking for companies that have shown strong financial growth, that have got a history of doing the right things with the money, that are reinvesting good sizable profits back into the business and doing that in the right way. There are many different metrics that I look for. If I find a company that tick every single box, which is extremely rare, they score highly. And if they don't tick all the boxes, it doesn't mean that they're a terrible company. Today we're going to look at a company that are probably not going to top the table, but they're a very interesting company, and let's take a look at the numbers. They're called JD Weatherspoon PLC. Okay, then let's take a look at JD Weatherspoon, Epic code JDW. These guys are in the FTSE 250 under the travel and leisure sector. So revenue growth has been very strong over the last 10, 12 years or so. We can see every single year here we've seen significant growth in revenues. This is a company that's able to bring in more business into the company, which is sometimes very difficult for many companies to do. Being able to grow and continuously grow is quite difficult, and but yet these guys have managed to achieve that so far, so that's a really positive sign. It means that they're able to get out there and they're either finding more customers, or they're raising their prices, or somehow finding more ways to bring revenue into the company, which is great. Go straight to expenses here. We can see expenses are very high in this business, and we would kind of expect that with the line of business that Weatherspoons are in, which is kind of the It's kind of half the pub industry and half the restaurant industry, I suppose, known for their pub grub. And we would expect the expenses to be high in that kind of industry. You can see they're up at sort of 93% of the revenue. So a big chunk of that revenue that they're bringing in is going out. What I like about it, if I can find a silver lining here, is that the expenses seem to be very consistent. So the revenue has been growing year on year. The expenses are growing year on year in relation to that, in sync with that. They're not growing at a faster rate. If they were, we'd see the percentage value of that revenue in expenses going up. We'd see these percentages going up, but they're not. They're staying around 92-93% every single year, and that means that the expenses are growing at the same rate as the revenue's growing. So that's good. It's certainly, it's not exciting. The percentage is very, very high. They're losing the majority of their revenue has just gone on the expenses around the business. It's only leaving them a very small amount of percentage there, but it's good in that respect that it's not getting away from them. Come down to expenses, interest expenses on debt, too high. These are too high. We're looking, therefore, these percentages here are the percentage of the interest expenses on the operating profit. So a quarter of the operating profit is being eaten up by interest on debt, and that's a lot. It's 35 million out of 131 million. So we're significantly eating into the profits now at this point, from the 1.8 billion that came in 2019, spending nearly 1.7 billion on expenses, and then of the 131 million that's left over at that point, spending 25% of that on interest on debt alone. Then once you factor in taxes, we're left with about 74 million in profit. So it's a profitable business, do not get me wrong here, and they have been profitable every single year for the last 12 years. The issue for me is the margin is too small. That's the only real issue here. I mean, what we're looking at here is a decent business. These guys are making their shareholders profit. It's just the margins are quite thin. We're looking at historically about 4% on average a year, just shy of 4% a year on average net earnings. That's too low for me in terms of what I look for. Bear in mind, I've got a list of 40 companies that I am doing deeper investigation into because they tick all my boxes financially. There would be no need for me to then go fishing into a company like this because these guys go nowhere close to the quality and caliber of the companies that I've already found. So, when I can invest in a company that's making 25-30% earnings per year, then why would I then go and invest in a company that's only going to be making me 3-4% a year earnings? This means that if there was a significant spike in expenses or a big tax bill that came along or interest on debt went up, let's say they needed to borrow more in 2020 and therefore the interest on debt went up, it could wipe out their profits and therefore knock them the share price down significantly. If this is a company that posts even 1 year of negative earnings, making a loss, then that could significantly hamper that share price, and that's not something I'm interested in. I'm looking for more security and more safety in strength, financial strength, and these guys just really don't have the financial strength that I would want to give me that kind of margin of error that I would want to see. So unfortunately for Weatherspoon, there's not a company that I would probably be looking to invest in at this stage because these numbers are just too thin. But don't get me wrong here, and a lot of people often misunderstand me with this show. They think that because I'm not investing, I'm saying they're a bad company. That's not the case. I'm saying that this is a very profitable company. They're doing very well, but it's just nowhere near good enough for what I'm looking for. Looking at the balance sheet, this also shows me some concerns here. The current ratio is 0.3, which is really low. It essentially means that if we look at the current liabilities, the short-term liabilities, they sit at 326 million. We look at the short-term assets, we're looking at 88 million. So short-term liabilities massively outweigh short-term assets, or the liquid assets that they can turn to cash quickly. Well, they're massively outweighed by the short-term liabilities that need to be paid within the next year. So that's a concern for me. That's an issue. I would come down to if we come down to the debt outstanding for me is too high for this company. We're looking at 776 million outstanding in debt. Well, based on the earnings power of this business at 74 million a year, that as of the last year, it's going to take them over 10 years to pay off that debt. And for me, that's too long. For me, in the companies that I look for specifically, I'm looking for companies that aren't carrying too much debt relative to their earnings power, because I don't want companies that have a huge amount of debts to pay off. It means less money for the shareholders because they've got to pay off that debt. And when there's a company carrying 10 years worth of debt essentially relative to earnings power, that's too much for me. That's too high. And so that's another reason I would be staying away. It doesn't mean they can't pay off that debt. It doesn't necessarily mean they're going to go bust or anything like that at all. It just means that the debt that they're carrying is too high for me, and it's going to eat into their profits too much in terms of the amount that they're going to have to repay and the length of time it's going to take to repay that. So for me, that's a no-no. Equity seems to be doing okay. Pretty stagnant between 2008 and 2012. The equity, which is the assets minus the liabilities equals the equity, hasn't gone anywhere over that period of time. Then we saw a bit of a jump over the next 3 or 4 years, and we have seen some steady growth over the last 4 years in equities, which is a better sign, and that's probably long-term assets growing faster than long-term liabilities, because it's shortly not happening on the short term. This is a company that like to buy back their own shares. I like that. I'm a big fan of that. Companies that are running their own share purchase system, where they essentially are buying back their own shares and reducing the number that are in circulation, therefore drives demand, can push prices up. It's all good. Especially if you are an existing shareholder and you're not one of those that's selling. Retained earnings is looking pretty strong. There's consistent growth in the retained earnings here on an average of about 15% pumped in a year. So this is growing, retained earnings growing by 15% a year. That's a steady commitment to that pot, so that's great. That's what I like to see. Return on shareholder equity is also pretty strong at 23.4%. Capital expenditure is quite high. That's a downside for me. I'm not keen on companies that spend a lot of money on capital expenditure. But overall, this is a decent company. I'm not writing them off in the slightest. A pretty healthy company, consistent. You can rely on them to be making 4% return, 4% net earnings a year for sure. And there doesn't seem to be any obvious reason why that would change. I don't like the expenses. The expenses are the big turning point for me, especially in 2020 when we've got a company that's going to be making very little revenue because of the lockdown, but obviously expenses are very high. Even with a furlough scheme in place, I mean, we're looking at 1.6 billion. That's a lot of outgoings with no income coming in, so that's a concern for me. There are other companies out there that have a far lower percentage expenses rate that are going to fare much better in 2020 than companies like Weatherspoon, where 1.6 billion is being spent on just running the business and they've got no revenue coming in 2020, or very little revenue, I should say, because obviously we don't know what the number's going to be yet. But that's a concern for me, of course, plus the 750 million in debt added onto that problem, and with only 204 million in retained earnings, that's not really going to help them all that much when they got 1.6 billion and that debt level. So that's a concern for me, and I think 2020 might be a dangerous year for Weatherspoon in terms of the damage it might do and how far it might set them back financially to get through that period. I'm not entirely clued up on all the news of Weatherspoons. If you know something about Weatherspoon that may flip that a little bit, or maybe it may add some insight into what we might likely to see in 2020, then please share it in the comments below. But for me, that's a concern anyway. That would be these numbers are a concern for me, regardless of 2020's events. Already by 2019, I mean, we can go all the way back to 2008 and I wouldn't have been an investor in this company. Now, like I say, doesn't mean they're a terrible company. It just means that they're not a company I'm interested in personally. Let's go take a look at the chart. Okay, so clearly this is a company that have been doing well. Let's bring this to 2008 where we've been looking at the numbers. So clearly the consistent 4% a year or so and the rise in revenue has appealed to investors. This is a company that from 2008 has grown from £3.25 a share all the way up to almost £17 a share prior to 2020. So this has been a good company to have in your portfolio as a growth investor, as a value investor. And they have been doing very well. So obviously it's come down from £17 a share down to £10 a share now. So there are going to be investors that are looking at this and thinking, well, if this recovers and goes back to what it was doing before, then this is a great opportunity to get in at a relatively cheap price. For me, I've just obviously got the concern of how long is it going to be before a company like Weatherspoon are back to operating at their normal level. They surely are going to have to cull some staff. I don't know. I mean, when you're running a business that's got a very small gross margin of essentially just a few percent, expenses being that high, and very little, if any, revenue coming in at all, that's almost guaranteeing a losing year, I would say, for 2020, unless they can pull something out of the bag in the second half of the year. But again, how long is it going to be before things are back to normal in this particular industry? Long term, I'm not interested at 4% a year. It's too tight a margin. There are going to be years where, you know, if there's a spike in expenses or a spike in other costs somewhere along the line, it's going to just wipe out any profit they had, and it's going to mean they're going to be posting losing years. That's not something I avoid companies that post losing years like the plague. Excuse the pun. But otherwise, half decent business. Let's go and take a look and see how they have performed on the leaderboard. Okay, so a couple of facts about JD Weatherspoon then before we wrap things up and chuck them up on the board. So they're trading at about £10 a share, as we've seen, and presently EPS score, earnings per share, sits at about 69 pence as of 2019. So based on your £10 a share price today, based on the earnings per share they achieved in 2019, we're looking at about 6.9% earnings return. So the way we look at that is, listen, if you were to buy all of the outstanding shares in JD Weatherspoon at £10 a share, and you own the company, you'd be making about a 6.9% return on the amount you bought. The 6.9% earnings isn't 6.9% net profit or net earnings that the company's making. They're two completely separate measures. The 6.9% return that you'd be getting on that is based on how much you paid for the stock, how much the price was. And what we're trying to do is we're trying to ascertain, does the price meet the value? The value of something is very different to what the current price of that thing is, right? And so when we're looking at a company or a business, we're looking at the value of that business, trying to ascertain what is it worth and what kind of price should I be paying for this company. Another way I like to do it is I like to look at the equity of the company and look to see how much assets or equity, so assets minus liabilities, how much equity are we getting for the share price that we're buying. What this suggests is that the price is a little bit high right now, but it's not bad. So ideally, giving you an insight here into the way I like to price things and how I work out a good deal, I'd be looking for £7. Now, I said this about another company running this process, and somebody commented and said, look, there's no way the price is going to go to that low. One, there's no way of knowing that, so that's a idiotic statement. Second, we're not suggesting the price is going to go to that level. This is not a prediction that the price will go to £7. What I'm saying here is that if we were going to buy this at a fantastic value, £7 would be a fantastic price. £8 would be a pretty good price. £9, an okay price. £10, I prefer to do better than that. I prefer, I mean, you're not getting a huge return on that. If you were buying at £7, you'd be getting a 10% per year return on earnings and a price to book ratio of 2.6, which is way, way better and far more. I'd perhaps be buying shares in Weatherspoon at £7 if the financials were good enough. They're not. So looking at the price is a little bit high. If the price came down to £7 a share and the financials were fantastic, I would be all over it. I'd be in. If the price went down to £7 a share, I still wouldn't be buying JD Weatherspoon, unfortunately. Just not a company that I've met enough of my metrics for me to consider them as part of my watch list of companies. Essentially, I have 40 companies on my watch list. They are fantastic companies, superb financials, ticking all of the metrics that I'm looking for. Therefore, why would I want to invest in a company that aren't part of that? My capital is going into those companies, and it makes no sense for me to pump money into a company like JD Weatherspoon, who are nowhere close to meeting my metrics, unfortunately, even if the price is enticing. I'll leave that to other investors who have a different strategy. So let's get them up on the board. Epic code JDW. Okay, let's have a look. This company scores a very average, maybe below average, 11 points. Let's get them up. Okay, so 18th place with the likes of EasyJet, GlaxoSmithKline, Tate & Lyle, that kind of level. Nowhere near the sort of companies that I would be looking for, unfortunately. We also lose Aston Martin. They're gone, knocked out the top 30. Unfortunately, that's going to be happening most weeks nowadays. We're going to be losing someone. But thank you very much for watching. I hope it's been an insightful episode, and I'll see you guys next week. Cheers.